So whether you have $10,000 to invest or 10 million, you're going to learn a ton from this video. Interesting fact about investing legend Warren Buffett that you may not already know. Despite currently being a billionaire many times over, Warren Buffett's first stock purchase cost him less than $120 at the age of 11. Buffett bought 3 shares of a company called Citi Services Preferred for around $38 per share. He has come a long way since those humble beginnings, and his current net worth is in excess of $100 billion. And he sits at the top of a company currently valued at over $600 billion. Now there's an important lesson in the story. You can start investing like Buffett even if you aren't a billionaire like him. In fact, you can get started with just a few hundred or thousands of dollars in savings. So in this video we're going to listen to Buffett talk about how he would invest if he only had $10,000 to his name. Now there's a ton of useful advice packed in this video, so you're going to want to stick around until the end because Buffett's advice is super helpful on how to get started growing your portfolio. Now let's jump into the video. Warren Buffett is asked what he would do if he had to invest $10,000. He starts off by saying, "Begin young." Laughter. Charlie's always said that the big thing about it is where we started building this little snowball on top of a very long hill. So we started at a very early age in rolling the snowball down, and of course the snowball, the nature of compound interest is it behaves like a snowball of sticky snow, and the trick is to have a very long hill, which means either starting very young or living very to be very old. I would do it exactly the same way if I were doing it in an investment world. If I were getting out of school today and I had $10,000 to invest, I'd start with ease. I would start going right through companies, and I probably would focus on smaller companies because I would be working with smaller sums, and there's more chance that something is overlooked in that arena. And as Charlie has said earlier, it won't be like doing that in 1951 when you could leap through and find all kinds of things that just left off the page at you. But that's the only way to do it. You have to buy businesses, and your little pieces of businesses called stocks, and you have to buy them at attractive prices, and then you have to buy them, and you have to buy into good businesses. And that advice will be the same 100 years from now. That's how he ends his interview. In terms of investing, that's what it's all about. One of the biggest takeaways from this clip of Warren Buffett is the concept of compound interest. There's a proverb that's frequently credited to Albert Einstein. The power of compound interest is undeniable. In fact, Warren Buffett's entire life and career is a perfect example of the amazing impact compound interest can have on building wealth. He once said, "Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it." There is no disputing the fact that Buffett has been a great investor since he was 24 years old, when he began working for his mentor Ben Graham in New York. But part of the reason he is so wealthy and so well known as a rogue investor is because of a rogue investor. Buffett didn't even become a billionaire until he was in his 50s. In fact, 99% of Buffett's net worth was earned after he turned 50. In other words, Buffett increased his net worth more during these 3 years than he did during the first 56 of his life. You should also take note of the fact that Buffett increased his net worth by over $30 billion between the ages of 83 and 91. He gained more wealth in just 1 year than he did in his first 59 years of life combined, with an average annual increase in net worth over these 8 years of nearly $4 billion. Compound interest operates in the following bizarre manner. Compound interest produces exponential, not linear, wealth growth. Let's examine the potential effects of compound interest on a $10,000 portfolio. Meet Jack, a 25-year-old who recently discovered investing in wealth creation through the fantastic YouTube channel Investor Center. Okay, jokes aside, make sure to subscribe to the channel if you haven't already because it aims to help you become a better investor. Our community now has 150 residents, and it would be even better if you joined us. With that out of the way, let's return to Jack. Let's say Jack invests his $10,000 portfolio over a 40-year period at a 10% average annual return. Just for comparison, 10 is regarded as the long-term average annual return of the US stock market. How much do you think Jack will have at the end of the 40 years? Keep in mind that all of this happened without Jack contributing another dollar. It's possible that his portfolio increased to $50,000 or $100,000 if you were extremely lucky, but Jack would have more than $450,000. Jack was able to increase his $10,000 portfolio to one that was almost $500,000 by simply having compound interest. In light of this, one of Warren Buffett's tips for growing a $10,000 investment portfolio is to get started as soon as possible. Referring back to our friend Jack's example, if we extend the time period by another 10 years, the investment portfolio increases from $450,000 to almost $1.2 million. Nevertheless, don't give up if you aren't incredibly young. The most important thing is to get started as soon as you can. The other factor that determines whether or not your investment portfolio grows is let's say Jack is able to obtain a 12 average annual return as opposed to a 10 average annual return. Since there are only 2 additional percentage points, you might naturally believe that there isn't much of a difference. However, with the 12 return, Jack's portfolio increases to $930,000, which is more than twice the size it was with the 10 return. This shocked me when I realized how what seems like a small difference in annual returns can have a tremendous impact on your portfolio size. So this perfectly leads us into the next section of the video where we can follow Buffett's advice on how to maximize your returns. Just for fun, let's increase the annual return to 15 and see what happens. The portfolio's value soars to nearly $2.7 million. Remember how powerful 10, 12, and 15 annual returns were in our compound interest example? Well, imagine how quickly your wealth would compound if you're able to grow it at 50 a year. Buffett has said on numerous occasions that if he were managing a smaller amount of money, he would be able to produce annual returns of 50 or greater. There is one important change that Buffett would make to his investment strategy that would help him generate those incredibly high returns. You might be wondering, why smaller companies? The answer to that question is shockingly simple. Less people are paying attention to them. As an investor, in order to generate high returns, you have to find companies that are extremely undervalued. As companies get larger, naturally they get more attention from professional and retail investors, and as the number of people that are following a company increases, the odds of that company becoming extremely undervalued decreases. Well, that makes sense when you think about it. Imagine you are looking to buy a house or rent an apartment. You show up to tour the property, and there are already 1,000 other people there also touring the property. What do you think? Your odds of getting a good deal are not very high due to the increased competition you're facing. Compare that if you showed up at the same exact property, but let's say the owner forgot to advertise the property and you just somehow happened to be the only one that showed up to look at the house. What do you think? Your odds of getting a good deal are definitely a lot higher than when you're competing with 1,000 other people also looking for a house. The same idea applies to stock investing. You should concentrate your attention on companies that aren't widely followed and receive little press. More often than not, these are smaller businesses. Another benefit of investing in small businesses was mentioned by renowned investor Peter Lynch. Small businesses typically have an easier time growing than larger ones. When comparing 2 businesses, one makes $20 million in profit annually while the other makes $20 billion, according to Peter Lynch. Which one do you think will find it easier to increase its profit by 10 times? There are only so many people in the world who can buy a company's product before the company runs out of potential customers, which is why it's difficult for extremely large stocks to grow as quickly as smaller companies right now. Going from $20 million a year in profit to $200 million is an increase of $180 million, but going from $20 billion in profit to $200 billion is an increase of $180 billion, so chances are it will be much easier for the first company. I have the perfect remedy for you though. It's called the stock screener, and it allows you to sort businesses according to a number of criteria. Company size is one of these characteristics that you can search by. Just going to the stock screener I found online, you can set a filter for companies of a certain market cap. In this particular one, I set the filter to companies between $50 million in market cap and $500 million. Now I have a list of companies that are between the size range I set in this filter. I can scroll down and look for names that potentially look interesting. If I want to take this one step further, I could also filter by price to earnings or P ratio. Let's say I want companies that are trading At a PE ratio of less than 10 but also greater than 1, I set the PE ratio to greater than 1 because I don't want companies that are losing money and have negative PE ratios to show up on this list. Now I have a list of companies that is further filtered down. These companies are both small and maybe potentially undervalued. This is what I would do if I was looking for stocks to invest in. I would scan this list until I found something that was worth more attention, and then I would begin researching this talk. So there you have it. I hope you guys enjoyed this video, and make sure to like this video and subscribe to the channel if you aren't already, because it's my goal to make you a better investor by studying the world's greatest investors.